Hello, good afternoon, Pittsburgh Foundation donors. For those of you that don't know me, I'm Lindsay Aroesty, the Director of Donor Services. I'm glad that you all joined us today. I have to say we have a record attendance for this investment performance update, which I suspect is due to the current state of the world. Maybe it's something to do. I know that in this household, we're constantly looking for things to do, but the current state of the world perhaps has also have you join today's webinar with all the uncertainty out there. So we're glad to be able to provide this opportunity for you to learn a little bit more about the Legacy Fund and how it is performing. But before we get started, a few housekeeping items so that you know how to participate in today's event. First of all, just for your knowledge, the webinar is being recorded. So if you'd like to follow up on something or distribute it to somebody else after the webinar has ended, you will be able to do that. We will follow up with a link of the recording to share at the termination of today's event. Secondarily, you can see me, but I can't see you. So you don't need to worry about how you're looking today. We have several folks on this webinar that have gotten dressed up for you, but you don't need to get dressed up for us. Also, on the right-hand side of your screen, you should see a bar with options on your own computer in the upper right-hand corner. We call that the control panel. You're listening in using your computer speaker system by default. If you would prefer to join over the phone, just select telephone in the audio pane, and the dial-in information will be displayed. Throughout this presentation, you will have the opportunity to submit questions to today's presenters by typing your questions into the question pane. So just familiarize yourself, look to the right-hand side of your screen and see where the question pane is. At any time, it won't interrupt us talking. You can enter in your questions about the webinar, and at the end, I will facilitate a question and answer if there are questions to make sure that your questions are addressed. And with that, today we will be discussing the impacts of the market on the legacy funds and the overall impact of the COVID-19 pandemic on the foundation and our operations. Our goal, as always, is to provide our donors with the same confidence, oversight, and due diligence for your philanthropic investments with us as you would expect from your personal investment advisors with your personal accounts. Today, as in previous investment calls, we will be joined by Pavilion Advisory Group and Cori Trautvetter, Managing Director, and David Thompson, Senior Consultant. It's at this point that I'd also like to hand over the presentation to my colleague, our Senior Vice President for Finance and Investments, Jonathan Brelsford.
Thank you, Lindsay. I'm Jonathan Brelsford. For those of you who don't know me, I oversee the finance and investments at the foundation. As a reminder for those on the call, the Pittsburgh Foundation's investment committee and staff work closely with our consultant, Pavilion and Mercer Practice, to oversee and invest the legacy fund. They assist us in asset allocation and manager selection, particularly in regard to alternative assets. Before we jump into the legacy fund performance, Lindsay, I understand though that we've had some questions from donors about the operations of the foundation. Maybe it'd be best if we address those first.
That's a good idea, Jonathan. So over the course of the past, let's just say 10 weeks, I've had donors contacting me and asking me some standard basic questions that I think donors have shown a lot of concerns around. So before we get into the depth of the presentation, I just wanted to shoot those back to you, Jonathan, if you'd be willing. Some of those comments have been, will my fund have to be used for foundation operation costs given the pandemic? Will I still be able to grant from my fund in the same way that I have in the past? And the kind of most common question that I get is, because of the pandemic, will my fees increase?
Thank you, Lindsay. First, let me say that the foundation and our operations are in a very good position. We transitioned in short order back on March 16th to work remotely from home and have been doing pretty much work as normal, all from the confines of our own houses, much as this webinar is being brought to you on my part from my basement. And we operate in a relatively conservative manner and with a strict budget that is approved by our board of directors. While the current economic crisis will likely have an impact on us, and at the very least, the assets of the organization, the manner in which we defer revenue effectively smooths our cash flow. Additionally, under the supervision of our board, we have been establishing an operating reserve that provides further support to us in the event the market values of our assets take an extended hit. So to answer the first question, will their fund be used for foundation operating costs? I would answer that all of our funds support the operations of the foundation through the annual administrative grant or fee that is calculated as part of the spending policy. However, no more than in the past. Additionally, the smoothing process we use for our administrative fees is also applied when establishing the spending policy, meaning that unless markets take an additional hit, I would expect the assets available for grant making originating from the principal of the funds to not be too dissimilar to what they have been in the current and preceding years. Lastly, we segregate assets intended for grant making in the coming year in the grant making fund. So the donor's current grant making budget has been unaffected by the current market turmoil. In regard to the second question, or really the third question, will my fees increase? The answer to that question is no. We have no plans to change our fees. We've always sought to keep our fees static and expect to do so now. As I mentioned, this is one of the reasons we utilize a 36-month average for fee calculation, which results in the smoothing of our operating income together with the operating reserve. They act as the proverbial belt and suspenders. I hope that answers our donors' questions, Lindsay, but if not, I would welcome the opportunity to discuss in detail with anyone listening.
Thank you, Jonathan. If additional questions come up, donors feel free to put into the chat box, but that does answer the questions that I put forth today. Turning to the legacy funds, can you give us an overview of them, Jonathan? What are they and how much is in each pool?
Sure. The legacy funds consist of the legacy fund itself, the intermediate fund, and the grant making fund. The legacy fund is our perpetually invested portfolio that funds the annual grant making for each of its constituent funds. Its approximate $320 million in assets are invested in a diversified portfolio that are of both public and private in nature, including equities, fixed income, real assets, and commodities. The intermediate fund is intended for assets that will be granted out over the next 3 to 7 years. It consists of investments in an array of mostly passive and all liquid assets, the majority of which are fixed income, however. With a target of 25% equity, it is still a fund that can and does lose money in significant events like we've experienced. The grant-making fund is intended for assets that are to be granted in the next 0 to 2 years and has assets that are comprised entirely of cash and near cash assets, such as the short duration bonds.
So how did each of these portfolios perform in the most recent quarter? I know the fourth quarter in 2019 overall was a very good year.
Yeah, so the first quarter of this year was very challenging, as this chart shows. As many of our donors and listeners already know, equity markets saw take their hardest hit since 2008, the 2008 financial crisis. Our portfolios performed as we would have expected each of them to in this type of market. While I'm never thrilled about a 15% loss that the legacy funds experienced, the diversified nature of that portfolio helped avoid even greater losses that would have occurred in a more traditional portfolio. The intermediate fund still took a hit, but the star was the grant-making fund with its short duration core fixed income approach. It has performed very well in an environment marked by falling interest rates. Additionally, I'd just like to point out markets have rebounded and through April, which we have performance, but that continued in the most recent month of May, we've seen very good performance. We've seen a solid comeback that has continued. So as you can see, the legacy fund at 6.1% for the quarter as a marked contrast to the prior quarter, but still year to date, we're down almost 11% in the legacy fund. I'm sorry.
So what do you think the future holds then for the legacy funds, Jonathan?
Well, I wish I knew. With the massive unemployment brought on by the coronavirus, I would have expected markets to remain challenged, but it seems there's a strong belief that both fiscal and monetary support asset prices will recover quickly even if the economy doesn't. However, aside from some aggressive rebalancing in the midst of the crisis and some modest tactical positioning with some of our credit managers, we are keeping to our strategy and letting things play out. I mean, we haven't even seen what a full quarter looks like in this new economic regime with unemployment numbers over 24%. So I don't know how anyone can properly price and discount a company's value. And yet we have seen asset prices increase, the primary reason for which has to be from asset price inflation brought on by additional monetary measures undertaken by the Fed. It is really an effort to prop up corporations and thereby the economy. Unfortunately, that means markets are as much or more overvalued than when the crisis first started.
What do you mean by that? The market hasn't fully recovered and neither have our portfolios.
So I'll ask David Thompson from Pavilion to answer that question.
Yeah, if we flip ahead to the next slide, just thinking about kind of where we were at the end of 2019, we were starting to feel pretty concerned about where equity valuations were. We have the P ratios there. So, the first thought would be, hey, we haven't gotten all the way back. Why are we still concerned? Or why are we think that really where we look at it, P ratios are about where they were towards the end of 2019, where we started to get concerned. Well, the problem is earnings have obviously fallen off a cliff with a lot of companies, and there's still a lot of uncertainty around there. So, while the government has done a lot to kind of backstop equities and backstop risk assets, we still maintain a pretty high level of concern and think that the downside risks are still pretty elevated. So, as we move forward, as Jonathan mentioned, we want to be very cautious in our tactical tilts in the portfolio and stay very balanced as far as our approach going forward, just because the uncertainty is so high and kind of where we are on the valuations on risk assets remains very elevated.
Yeah, and I mean, I think we see here, David, and you can tell me if I'm wrong, the asset value, the price values in Europe and the emerging markets, while we've suffered in those areas, remain much lower than the United States.
Yeah, absolutely. U.S. equities had quite a bit of outperformance leading into it. The downturn with the pandemic, they let us out to a certain extent as well. So we kind of in an absolute valuation case, we think that there are opportunities in Europe and in emerging markets taking that long-term perspective as we move forward. And that's what's represented on that graph on the top left-hand side of the page. And those positions are really reflected in the legacy funds allocation throughout equities, with a significant portion of those being allocated to emerging markets and international developed equities relative to the U.S.
That's great. Thank you.
So I see that you're talking about still having a lot of equity in the portfolio. The grant-making fund, as you showed on a slide earlier, Jonathan, has had some great returns. Why wouldn't we have more fixed income in the portfolio?
I'm going to ask Cori to answer that question.
Sure. I'm sure most of you at some point have seen a phrase, maybe on a financial statement, where it says past performance is not necessarily indicative of future results. And I would say that phrase really sums up what our expectation is for fixed income on a go-forward basis. We expect investors to really only receive the yield offered by fixed income today, which is very, very low. The 10-year yielded 0.7% at the end of the first quarter, and that is basically where it sits today. So looking ahead 10 years, if you invested exclusively in a 10-year government bond, you can get 0.7% back in terms of a return on those types of investments. And if you go to slide 6, specific to the grant-making fund, really the reason that fund did so well is really based on how the fund invested, which specifically ties back to its objective and intent of the fund, which Jonathan mentioned earlier, which is to grant out those assets within the next 2 years. And so kind of given that time frame, the need for liquidity, the goal of preserving that market value of those assets, the grant-making fund is comprised entirely of cash and short duration bonds. And as we saw kind of during the March panic in the markets, liquidity evaporated, measures of financial market stress spiked to levels not seen since the financial crisis. And really fixed income was not immune to this, as you can see with the spread chart. on this page, in which we saw spreads widen for really all non-treasury sectors. We did see the Fed quickly respond. They provided a lot of liquidity to the markets, including kind of relaunching some of the financial crisis era programs, as the Fed cut their target interest rate to basically zero. So the two keys of success to the grant-making fund were really the significant cash treasury exposure that we had, as well as its shorter duration positioning. Now, it should also be noted that this high quality kind of core fixed income approach within the grant-making fund and that implementation and objective for fixed income is also used in the legacy fund. It's actually even used with the same manager. However, there are slight modifications around duration, given the fact that the legacy fund has a longer term time horizon. And so the duration profile there is a little closer to market duration.
Thank you.
That makes sense.
So I think that's really all we had planned to present here, Lindsay. I don't know if there are there questions for us that have come in, or that our donors have had since we announced this.
So I'd like to give donors a chance. There have been a couple of questions that have come in. I'd like to give those of you that are on the call a chance while we're answering the questions to type your questions into the question pane. There have been several folks that have joined us as the webinar has gone on. So just on the right-hand side, you can type in any questions. But in the interim, there have been 2 questions that have come in. The first was, will the spending policy, or for those of you that are familiar with the word spending policy, the amount available that you have for grant making, will that change as a result of the pandemic, Jonathan?
It won't change this year at all. As I mentioned, the spending policy has a smoothing component to it, but we set the spending policy at the beginning of the year. There's a meeting that we hold, both the investment committee and our finance committee have a discussion about what that spending policy should be. So that occurs in the 4th quarter of every year for the coming year. So back in November, we met and set the spending policy. We try we're very circumspect about when we would change the spending policy. The aspect of a 36-month rolling average that we apply the spending policy of the, I should say, step back, 36-month average of the assets, right? So that's a 36-month average. It goes back 3 years from September to September. That smooths out any significant increases or decreases. So when we set the spending policy, although we do set it every year and evaluate it, we really don't see major reasons to do that. We have been discussing potentially changing the spending policy, but really only because we're looking at forward expected returns, not what has already occurred. So the short answer to that question is no. We don't anticipate any changes in the spending policy, and certainly not to the grant making in the current year.
Okay, that makes sense. And there's 2 more questions here. The first relating to the spending policy, since we're on that topic. The question was, when the market crashed in 2008, did the percentage of the spending policy change at all, or has it been in the same in the past decade or so?
Yeah, we have, again, we haven't changed it in my tenure here with the foundation. I believe it was changed to 5% around the turn of the century, as I like to say. But again, it's more of a perspective discussion about what we think markets will, and the opportunities that markets will present to us.
Gotcha. Thank you. Another question has come in. What kind of aggressive rebalancing was undertaken and why?
Yeah, so when I say aggressive rebalancing, that just means that we were quick to make that happen. So we have a strategy that's set for the portfolio. We have target ranges for each asset class and each sub-asset class. And when we experience a downturn like we've had in the past quarter, we're really looking to take advantage of the fact that what has occurred is our allocation to a specific asset class has changed dramatically and goes outside of our range. So by bringing assets more in line with our target, we could conceivably capture some additional sources of return. So what happened, and we did, when I say aggressive, this happened in the last week or weeks of March, where we took money away from fixed income managers that had performed well, right? Those assets did well at that time, and we put them back into equity. Now, we got fortunate in that timing, but again, that's really based upon that good fortune is related to our discipline about looking to rebalance into falling markets or rising markets for that matter. So, you know, one of the questions that we're having right now is, have markets come back so much that we may want to rebalance back into fixed income to remain a little more defensive, or I should say, potentially into our some of our diversifying strategies like hedge funds or hedged credit. I don't know, David or Cori, if you have any other thoughts on rebalancing and why.
Yeah, I think just history has shown us that being very systematic and rigorous in that regard, it will reward the portfolio. So, you know, certainly in the middle of March, it did not feel like, you know, kind of in your gut, maybe like it was a great idea to rebalance into equities. But, you know, as we look back and we're 40% higher almost on equity markets, it clearly was the right decision. And, you know, so I think that conservative approach, and by conservative, I mean, maybe we don't go all the way back to target, but certainly putting quite a bit of money back to work into equities was the right decision. And, you know, we did it with eyes wide open that there may even be another chance or another time that we would want to do that again. And, you know, as we sit here now and with clients that have kind of shifted to the higher end of their policy ranges, we think it, in the same vein, makes sense to have those discussions about pulling a little risk off the table just to stay close to those long-term targets.
Yeah, the only other comment I'll make to that is, in addition to rebalancing, you know, I think Jonathan kind of alluded to the fact that we've also been attempted to be a bit more on the offense with some of the underlying strategies as well, some that might have suffered a little bit of more market dislocation than others. So given the legacy fund's long-term time horizon, we were able to capitalize and put more money in those areas where we felt that, you know, the risk reward opportunities were very compelling and that the dislocation was temporary to kind of short term in nature. And so the fact that we've kind of kept that discipline, but also being able to quickly pivot to being more opportunistic and not have to be defensive with the portfolio positioning has played out very well.
Yeah, I think that it reminds me of the maxim that you want to be buying when everybody else is selling. And that's really what we were taking into account at that time.
Great, thank you. So those are all the questions that have come in. So unless anybody else has anything, we're probably going to close out today's webinar. I just want to say on behalf of the Pittsburgh Foundation, thank you so much for tuning in. It was great to have you here with our record attendance. And thanks to Cori and David for joining us. We will end the webinar, and if you have any questions, I'm pretty sure all of the attendees on this call know where to find me. So please follow up if you have additional questions. Thank you.
Yes, thank you very much.
Thank you.